I'd like to welcome to the stage for a brief Q&A for Meet the Investors, and then we're going to hand it over to our esteemed keynote presenter today, President Vicente Fox. If Bobby, Ryan, and Brett would like to come up and join me on the stage. As I had said earlier, we are now moving forward with our Cannabis Select Fund at Bonaventure Equity, and part of what we're going to represent in this conversation is introduce you to some of the people that have traveled from out of town to come here and be with us today, so that you can get some perspectives from some of the venture capital investors, some of the family office investors, some of the private investors and operators who are leading this industry forward. So I'd like to have everybody come join me. It's a unique opportunity for you to get to hear from some of the key people driving the industry. So I'm going to start with a good friend and local Boca investor, Brett Finkelstein. Tell us a little bit about his firm.
Hi. Thanks for having me with us, as always. My name is Brett Finkelstein. I'm a co-founder of Phyto Partners. Phyto Partner is an investment fund that is investing in the ancillary or ecosystem ventures in cannabis. We look at the industry as the next great asset class that is going to produce generational wealth for our investors. We're activist investors. We invest in 18 companies to date. The ancillary ecosystem, as it's known in cannabis, is things like health and wellness, safe packaging, distribution, banking solutions, seed-to-sale tracking, anything that's going to be powering the business, and that's what we continue to seek and source new companies for.
My name is Ryan Ansin, here down from Boston. Happy to be in the sunshine. I have been investing in the industry for 4 years now, 4.5 years. Hold 14 companies, mostly minority, but I do lead the rounds with my family office and often come in with co-investors. These types of panels, generally I feel like it's a little unique because we're in a very small camp of folks in the cannabis industry that don't need capital, and we don't want capital. We like being useful and here to help educate other folks, but we are invested heavily in genetics, heavily in automation, and our largest holding is a company that I started, co-founded in Massachusetts called Revolutionary Clinics, which has the largest cultivation in the state indoors, and the only company that has 3 Metro Boston locations, going to 9 within the next 18 months or so. But as we'll talk about, the regulatory challenges make nothing easy.
Hey, I'm Bobby Leidy. I'm one of the co-founders of Tilt Holdings. Tilt is a technology and infrastructure platform operating in the cannabis space today, offering both B2B and B2C products. So we are a multi-state cannabis operator with logistics, technology and software, and a hardware component. We got into the market originally through an SPV that we created to invest in a single license in Massachusetts, which has grown to over now 8 states across the country on the B2C side. We recently completed a merger and a public listing where we now have access to over 1,200 dispensaries around the country through Baker Technology, which was one of our merger partners based in Denver, Colorado, as well as Brightside, which is a modular construction company, and Sante Veritas, which is a Canadian LP.
Guys, thank you very much. We've been fortunate to learn from you along the way over the last several years, and everybody here has a bit of a unique perspective. I'd like to put one question forward to the panel for all of you. When you first started to look at the cannabis industry as an investable marketplace, what were the things from your perspectives that made it most attractive and got you active in the space, right?
Well, for us, I think originally was the research and the science part of the plant and medicine, and also understanding that for us and the companies we was looking for was it's about getting well and then getting high. But for us, I think we saw an opportunity to invest in the space that is really typically unmet. Tons of capital needs are unmet in this space, so we just looked at it as an opportunity, and looked at the asset class that for us that we could come in early, identify companies, work with companies, be active in the growth and hopefully amplify their trajectories by our network connections that we've made in the years. But at the beginning, I think it was really based on looking at it as a new asset class, understanding how large the industry could get, and infusing the capital because it was unmet and there wasn't a lot of people like us doing it. So, we've been doing it for 3 years or 4 years now, which is kind of a long time to be in this industry.
Originally, I was attracted to the modifications of the social justice issues, which attracted me to look at the industry. And then once I started to dig into how we could actually make money, what I really liked, what I really liked about this industry was by the nature of turning states on that will inherently have really high pricing per pound or per ounce per gram. Initially, if you're a line leader, you can make your money back quickly and then start to get creative with the portfolio of companies that you're working with or investing in to continue to have a longer profitable trajectory. So I really like that. And then I like the slow-moving, frankly, dynamic across the United States that allows you to take learnings from one state, not rush into the next, but plant just as deep of roots into the next one, having learned so much where you originally were, because not all states are turning on at the same time. That's a really unique element of this industry compared to everything else, that you can educate yourself and move on into the next space once you're ready, as opposed to trying to do everything and be everything to everyone. So there's some really unique elements of this particular industry that provide for venture-like returns with private equity-like risk profiles.
Yeah, so in my former life as a wealth manager at Deutsche Bank, I got into this industry about 3 years ago for an investment I made in REIT here in Florida. We met with the management team and quickly realized what the opportunity was in the industry. You've got an industry that's roughly 80% self-financed today, so highly fragmented, mom-and-pop operators with very limited access to capital, huge barriers to entry, bans on interstate commerce, so very challenging regulatory framework, and obviously the federal and the state disconnect. We saw an opportunity, as Brian was saying, obviously, to look at the social components of the industry, both the medical components as well as on the adult use side of things. When you start to look at states like Colorado, we did $249 million of tax revenue last year at the point of sale, with over 25,000 jobs in that market. You see all the opportunities there, but then you also start to realize that you've got an industry that's throwing off 80% gross margins, roughly 40% net margins on the plant-touching side of the business, with all of those challenges that exist, ideally around limited access to capital. So we saw it as an opportunity, number one, to invest into this industry, but then quickly realized that the only way that we were going to really scale up, as opposed to going and taking minority positions across the country, was to go out and hire the best possible people we could find that specialized in every point of the vertical, both cultivation, manufacturing, and distribution, and really built our company as an operating company to scale across not only the United States but also globally.
Thank you. And so, Bobby, on that point on being an operator, I'd like to actually ask Ryan a question and then bring it back to you. Ryan, being very hands-on and involved day-to-day, what does that mean for you with wearing both hats, multiple hats, looking at this industry? And then, Bobby, I'd like to hear that from you as well.
Yeah, it's a sleepless activity for sure. The plants never sleep, and so we're not able to either. What's really fun about operating and investing at the same time is that you can call people on what I see often as fraudulent information on their decks, which is the kindest way of saying it. There are intricacies to every vertical of this industry, and each vertical is a ridiculously deep rabbit hole that you can spend years becoming expert in. But having spent 12 hours a day, 14 hours a day operating the company. Now we have a wonderful CEO who's really taking it operationally to the next level, and I remain the Chief Strategy Officer on the board. But you're able to really dig into what the realities are of each technology, of every line that you hear about lighting, of every line that you hear about in the nutrient side of automation. You understand the pain points such as trimming. Hand trimming 150 pounds a week is what Tilt is getting in Massachusetts. We're in a similar boat. Hand trimming, that is a huge pain point. You need to figure out solutions to the actual realities, not what people would fathom to be a potential in this industry. So that's been a really key learning for me. The other element that I love about this combination of operating and investing is for the assets that I invest in that are applicable to our company, I feel like I make my money back immediately. So when people ask me, and we'll dig into this more later in the questions that I saw, but when people ask me what should they be doing to start getting involved in the cannabis industry, I often or always say almost to start with a really base platform that you can then put those assets into to enhance your operations, to expedite your grow, any of these types of things to increase the bottom line. So then I make my money back within the first 6 or 12 months if we get the first robots off the assembly line, for example. And if I get venture returns 7 years later on down the road, then all the better. But we've not seen a full venture cycle in the legal cannabis industry yet, and so I'm not putting all my eggs into the basket of hoping that this works out within half a decade or a decade.
So I've had just so much fun building this company. Culturally, the cannabis industry is full of amazingly talented people, extremely passionate people, people that really want to bring this product out from the shadows and into the light. So it's been amazing, and that's probably been one of the biggest accomplishments for me, having co-founded this company like Ryan now, bringing in a COO and a CFO and really laying the groundwork and the foundation for a big, a successful company, and now taking kind of an outward look at it. Something I'm really proud of is building that culture. From an investment standpoint, what's been really interesting to watch is markets like Massachusetts, where we're currently operating in, as is Ryan, that's just recently converted from medical to adult use. Typically speaking, there's a massive supply-demand imbalance that exists right away, right? In a medical market, the average per resident spend in that market is around $15. And then if you're using comps from Colorado, it goes pretty much overnight up to close to $300 per resident living in that state with very limited access to supply. So it's a very interesting time in those markets, but eventually as supply catches up with demand, you start to see saturation take place, and that's something that we're starting to see in Oregon and other markets that have evolved over time. So where we get really excited is starting to look, going a little bit further back in the supply chain and looking at recent acquisitions for us. Blackbird out of Nevada, which has a 90% market share in that state, is a distribution and logistics company. Now going into California, also into other markets. Jupiter Research, which is a vape hardware company, inhalable hardware company, who's growing at extremely high rates. In 2017, they did 25 million in revenue. Last year they did close to 85, and this year they've got a run rate of 200 million. So starting to look back and really see what's going on across the industry and thinking about how we can provide those services to the industry gets very exciting.
So, Brett, when we talk about operations and generically venture investing, you're always looking at the management team and things like that. Could you talk a little bit about your perspectives as a more traditional venture, and how do you evaluate new opportunities that come to your fund?
At this point, we've invested in the last 3 to 4 years, 18 companies, so it gives us, great optics to the industry. We could sidestep a lot of the, as Ryan said, false claims in the industry. We really have boots on the ground from the companies that we've invested in, but also the network of people that we touch and deal with all the time. For us, it's really going to come down to, the source of the transaction, where we're getting that from, but really it's going to come down to people first. You know, we haven't invested in anything that's plant touching or cultivating, as you know, I hit on before. So for us, it's going to be about, you know, a seasoned and experienced management team, you know, low capex, hopefully some proprietary technologies. A lot of the stuff we're doing is early on, so there's not going to be a lot of sales. But you know, for us now, and I think for everyone here on the panel, is that there's going to be a lot of, you know, noise.
We had a company present in New York that was pre-revenue and trading at 20 times. Well, no, it was under $2 million in revenue and trading at 20 times and spinning out 2 pre-revenue assets, and just couldn't quite sort of understand that, right? So I'm fortunate to have known these gentlemen for some time and get access to them, which is terrific from time to time. But I'd like to open it up to the floor for any questions from anybody here, having a chance to pick the brains of us. Can you just speak up and I'll repeat the question?
Yeah, I have a question regarding
Yeah.
regarding valuation. You look at most recently, you know, the Constellation invested quite a bit of money in Canada growth. You know, you're reading some of these other big beverage companies. How do you think that plays out? Obviously, they're doing their due diligence. They're not just throwing, you know, they're trying to that kind of point at these companies. What are your thoughts on that? Because I agree with you. The valuation of some of these stocks is insane. But you see these big companies, obviously, you know, very successful companies, long-term thinkers like yourself, throwing a lot of capital.
Yeah.
So I like to think about it.
Sure, and I'm happy to follow up afterwards, but the short answer is Constellation putting 1.2 billion and then totaling 4 billion after that, 4 or 5 months after the first investment. How does that play out is your question. It plays out in a number of ways. One, so how did they think about going in? I wasn't in the boardroom, certainly not invited. But I would imagine that they thought about going in as a hedge, because in every medicinal state that comes online, alcohol sales go down 15%. So that's the first basis of going in. They're not nervous about not being profitable anymore. People are going to continue to drink beer for a long time. But as you're seeing with Lagunitas creating the high hops beer, they're diversifying their next portfolio of assets. And so for Constellation to go with Canopy, which was and continues to be, they still play double dutch with Tilray, but I think it's still the highest market cap company out there. How many options did they have to place $4 billion? Not very many. While I am thoroughly nervous about every Canadian stock that is valued off of current or future funded capacity, which is how a lot of these things happen to get there. I'll finish that sentence. I'm nervous about that because that funded capacity is supposed to be going to Argentina and to Germany and to Chile or wherever else. You can't tell me that the sunshine in Argentina isn't fantastic. You can't tell me that the engineers in Germany aren't sophisticated. And so each of these countries is going to create its own cannabis business. And so I don't see great longevity to those high valuations. But as I said, there aren't a lot of options for Constellation and the like to get involved. I had a bit of a closer visibility into the deal with Kronos, and I get it. If you're looking for fast-paced distribution initially of CBD products, and then perhaps depending on the geography, expanding from there, they had to make a move. So I'm happy to talk about it more, but that's the basis.
Next question? Unless anybody else would like to answer this. Sorry. Go ahead.
Voice is so outside of investment metrics like transparency and risk. Outside of investment metrics like transparency and risk and everything you're talking about, what's the biggest hole, do you think, in the industry, maybe from a supply chain operations standpoint, that somebody needs to fill for this thing to really grow and scale?
Pretty simply, I think it's operational expertise and access to capital. with the industry being federally legal currently in the United States, there's zero institutional capital in the space. So every dollar that we raised was raised primarily through friends and family, and then ultimately through quasi-institutional investors, family offices, small private equity funds. But that's why Constellation's investing $4 billion in Canada, because Canada is federally legal. The challenge with that is currently today in Canada, you've got about 14 million square feet of canopy coming online, which would represent a massively oversaturated market, right? And so their play is to try and get product into the EU or into Australia or around the world, and those markets today just currently aren't where they need to be to absorb that product. So I think today in the United States, it's that disconnect between the federal and the states, and whether it's the States Act or the SAFE Act or something like that, but opening up access to capital and then building an operational expertise.
I hear those points and disagree. I think the market speaks loudly, speaks volumes in this industry, and if you can't be funded, I think you shouldn't be. There's plenty of money coming into this space, more every day. The funds, just if we're between 3 and 4 years each in this industry, from the time we first stepped foot into it to now, the funds have gone from 25 million pieced together from 25 very risk-loving people to, there are 2 people who put their toe in the water, say that they're going to start a fund, and within a couple months they each raised over $200 million. That's of course not massive institutional capital. We're not there yet, but I actually think that the industry, at least in at least in the United States, is growing slower than the investor appetite is growing. So I think investor money's there. Professionalization is here. All of these Fortune 500 companies to come into cannabis because there's so much more growth opportunity here than there. And the cat's out of the bag on their being concerned of telling their wives or their husbands that they're coming into the cannabis industry. What I think is the biggest hole is everything that it takes to lead towards consistency in product and greater capability of growing and then isolating the most interesting cannabinoids that are in this plant. So consistency is the number one issue in this industry. And because you need to start operations in each state, it's very difficult. I often tell people, I analogize that Chipotle had sold billions and billions of dollars of food before they had a health scare, and they lost 75% of their share. That's from regional distribution centers and fantastic SOPs. In cannabis, you have nothing regional. Everything is state by state. Everything is in startup mode, and the genetics are wildly inconsistent. And so starting from the base level of considering where you're growing this from, how it's being grown, what inputs are coming into it, it's a drastic problem. It's a serious problem right now. So I think that's the biggest hole. And the people that really figure that out, whether that's through tissue culture, whether that's through seed banks, there are a number of ways to skin a cat. But I think consistency, starting with genetics all the way through to the end product, will allow for a greater level of professionalization and thus a greater level of institutional capital to come into the space.
Yeah, I agree with both Ryan and Bobby. I see a transfer of talent coming into the industry that I've never witnessed before, and I guess being an old-timer for 4 years. Better entrepreneurs, better managers. I see also, as Ryan said, more and more sophisticated influx of capital coming in. Maybe that's what is pricing deals higher, valuations, through the roof. But the business is really driven a lot by, regulatory issues. And in certain states, there's no federally, kind of mandate of as Ryan says, consistency. But as the market kind of grows linear, for us, the asks are getting higher. So, where we used to do a transaction, maybe, early start, back in the napkin, we love the team, a few $100,000 up front for the first round, that's over, because the market is so much larger, the addressable market is so much larger. The asks are maybe the same, and maybe, in a few rounds of getting there, and we follow on the companies that are performing for us. But since the market is so much larger, the addressable market to capture the asks for these companies are getting a lot larger.
I also think, though, that necessity breeds innovation and breeds greater strategic thinking. So before, in these early stage companies, they take the $250,000 and do something with it and build their valuation organically. And now they're coming to the table with 6 pieces of paper with fancy language on it, maybe it's fancy, and pricing it at $30 million. So I like where it used to be.
For us, our returns were a lot greater when we could invest those kind of numbers. But I agree with you that plans are never met. Projections haven't been met for us in the companies we invested in. But the asks are getting higher because they believe the market is there. And like Ryan said, something. Stocks or something in Canada before they went recreational adult use, as Ryan said, was also based on patient count. How many patients could I serve? Not how many people are buying marijuana, those patients, but also assumed capacity and how much could I build, and that's really based on if they sold every pound or kilogram of marijuana that they produce. And then in Canada they have this kind of biological asset configuration. So your gross revenue, your gross profit might be more than your revenue in some of these accounting Canadian companies.
I'm just going to say that going back to the institutional side of this business, when we talk about capital, it really is, though, it still is a challenge because we're looking at properties right now to go into for retail, and we can't go in if there's bank debt on those properties, right? The banks will not allow us to come in if there's a traditional mortgage on those properties. When we're looking to raise capital, it's in the, on the credit side, it's in the upper, very high teens to do that. There's this perceived 20% cannabis premium on everything you touch, and that's just because the industry has not become sophisticated enough yet to the point where you're starting to see rates and things come down to a normalized level. So until you start to see traditional institutional capital, bank capital coming into the space, I think the mom and pop are going to continue to be hurt by that.
That's a great point. Gentlemen, thank you so much. Really appreciate your time. Look forward to working with you, and encourage everyone to have some time to get to meet in the networking. I'd like to now move on to our keynote presentation. Thank you.